Let's zero in on the Magnificent Seven because the basket of tech stocks lost $652 billion in market cap just on Monday alone. But we are seeing a little bit of recovery here. If you take a look at NVIDIA on your screen, that is up nearly 4.5% on the day. Microsoft shares up over 2% and Meta trading to the upside as well. But the big question, what is next for the big tech names that have driven the market to over 35 all-time highs this year prior to the recent rout? Joining us to discuss that, we've got Maxwell Grinacoff, the U.S. equity derivative strategist at UBS Investment Bank. Maxwell, it's great to have you. So in your note, you mentioned that the AI narrative and real yields remain the largest drivers of returns. Can investors still continue to kind of rest on their laurels of the AI trade moving forward for the second half of this year, given what we've seen over the past few days?
Yeah, thanks for having me. So look, what we've been telling clients is the sort of initial move in volatility on Friday was definitely warranted, and it was really a story of everything, everywhere, sort of all at once. So as you allude to, from a fundamental standpoint, in addition to the AI tailwind concerns that you had, from a lot of the sort of major tech bellwethers through earnings. You also had growth slowdown fears creeping back up when it comes to the macroeconomy. You also had geopolitical and U.S. Election risks rising, right? Obviously, a lot of sort of technical risks that also led to the VIX spike on Friday and yesterday. But I think moving forward, we do want to actually have a sort of long quality bias, and think the sort of low quality pockets like small caps relative to large cap growth in tech could actually continue to underperform in the near term.
Maxwell, as we're trying to figure out just where we are within the midst of this sell-off, we are seeing some of that buying activity today. Something stuck out to me in your note, and it was the early warning signal that you had been flagging, a higher probability of a more than 5% absolute move here over the next month. I'm curious, have you seen an update to that following the last 3 days? And I guess what is that then signaling to you now?
Yeah, so the great thing about this model in particular is it doesn't tell us when it's raining, it tells it is likely going to rain. So over the last couple of weeks, we had actually started to see that move downwards in terms of telling us or flagging to us that we were going to have a higher probability of a plus or minus 5% move over the next 1 month. We obviously clearly got that, over the last, couple of trading sessions. But the biggest driver in that particular output that we flagged was actually Fed policy expectations, post FOMC in particular. Now, something to note, and the real common denominator here is that when that model in particular looks back to history, typically when you move into a Fed cut cycle, it's usually accompanied by a recession, several months after. So that R word, as I noted, right, that's going to be key over the coming weeks and months in terms of the data coming through. CPI next week, Jackson Hole at the end of the month, September FOMC obviously next month, right? This data is going to continue to be very pertinent in terms of sort of what that model is going to tell us going forward.
So how should investors be positioning ahead of an anticipated rate cut come September?
Yeah, so it's interesting, right? And this was sort of, flagged as a sort of not so ugly when we considered the good, the bad, and the ugly, when it came to the moves over the last couple of days. And typically what you've seen historically is you've seen volatility or the VIX rise into Fed rate cut cycles historically and retrace thereafter, unless, again, accompanied by recession. So right here, right now, right, and we're already starting to see this play out, we do think volatility ultimately fades a little bit from here unless the data really continues to sour. That is, bad is really bad and the Fed is behind the curve, whatever it may be, right? But we do think it's going to take a few weeks to do so, and our models are suggesting that again the data is going to be very pertinent over the next couple weeks in terms of kind of continuing to see a retracement back to normal. But we also don't think we're getting back to a VIX at 12 environment, for example.
I want to end on the VIX since you bring it up. We saw it basically tripling overnight here, but we didn't see a lot of stocks hitting 52-week lows, especially as we opened up this morning. Given that kind of divergence, what opportunity does that spell for investors in picking maybe specific stock names?
Yeah, and that goes back to kind of what I alluded to before. The move yesterday was clearly dislocated from reality, right? We do think there was a lot of technical factors in the VIX relative to the S&P 500 index or the Nasdaq or the Russell 2000. You did have investors sort of rush to buy downside protection post NFPs, post Bank of Japan, which we had noted for several months that investors had not been doing. So investors were much less defensively positioned than they had been previously. So that's why we think you saw, the largest intraday VIX spike in history next to Black Monday in 1987, right? But also the sort of largest intraday retracement in history, as a lot of those sort of hedges that were put on were monetized. Keep in mind, the S&P was only down 3%. We've obviously had larger moves, in history. When you look at the analogs, 1987 down 20%. March 2020, you had some down 5, down 10% days, right? So the reactivity in the VIX relative to the S&P move or other major indices was clearly dislocated from reality. And we do think there's room for normalization, and we're obviously seeing that in the price action today, with investors using this as a sort of buy the dip opportunity.
All right, Maxwell Grinacoff, great to have you here. Thanks so much for joining us. U.S. equity derivatives strategist at UBS Investment Bank. Thank you.
Thanks.